Hey guys, thanks for joining me. My name is Dexter, and today I'm going to be talking about how to get approved for a personal loan, even with a bad credit score. So in this video, I'm going to be discussing 5 key factors that you definitely want to consider before applying for a personal loan. So jumping straight in, number 1, you want to ensure that your FICO score at least meets the minimum requirement of the lender that you're applying with. The reason for this is not just because they might have a knockout rule or cutoff requirement for this minimum FICO score, which is oftentimes around 640, sometimes 600, even sometimes 550. But the reason why you want to meet that minimum requirement is if you apply and they are required to do a hard credit pull on your application, that could negatively impact your ability to get credit in the near term after that, even if you don't get approved for the loan. And number 2, during the time of the application process, you want to ensure that you have an income. And this is income that you can prove that you have and you can validate that. And that might be through a W-2 or through 3 to 6 months of pay stubs to show that you have a current income, because lenders are going to be looking out for whether you have money coming in that you can then use to make your monthly payments on your personal loan. And number 3, you want to make sure that you have a reasonable debt to income ratio. And a debt to income ratio is essentially your total debt obligations on a monthly basis over your total monthly income. And your debt obligations could include your credit card payments, your auto loans, your mortgage payments, and also potentially your child support or alimony or student loans. These are all examples of your debt obligations. And when you add those things up, what is that as a percentage of your total income? So let's say, for simplicity's sake, all your debt obligations add up to $5,000 and you make a gross monthly income of $10,000. So your debt to income ratio would be 50%. Usually the rule of thumb is you want to have it below 36%. So you want to go through your bank statements and all your bills and payments that you have with your existing debt obligations, add them up and see where you stand and how you could potentially reduce those, because having a lower debt to income ratio means that the lender knows you can potentially take on more debt in addition to the existing debt obligations that you're already paying on. And number 4, you want to recall whether you took out a loan in the last 3 months. This is a typical question that lenders ask when applying for a loan, because they want to know if you've taken on any recent debt obligations. And maybe this is something I don't need to really bring up, but you really want to be truthful about that too. The reason you want to be truthful about this is if on your credit report, it's been almost 3 months, but not quite there, and you say you haven't taken out a loan in the last 3 months, but you have, then that can cause for an automatic rejection. Now it's not a matter of whether you're able to pay or willing to pay. It's just a matter of this is part of the bank or lender's procedures to reject an application that has given false information. So you really want to keep that in mind when you're applying, is whether you've taken out a loan in the last 3 months and being honest about that information. A lot of lenders nowadays are very savvy in their application process from a verification standpoint, so they're able to have a fairly reasonable visibility into your financial standing, and being truthful on this is important during a loan application process. And number 5, you want to be very specific on what your use of funds is. That means, what are you going to be spending the loan money on if you are approved? This could include examples like credit card refinancing, debt consolidation, home improvement, or maybe paying off your student loans. Whatever your purpose is, you want to be very clear on this. And obviously your use of funds could be used for multiple purposes. Usually to simplify the process, it's easier to have one reason for applying for the loan. But let's say, for instance, that I'm applying for a loan for home improvement. It's going to cost me $15,000, and I'm going to state there that I need $15,000. The reason for this is, if I ask for $50,000, the lender might ask me what is the remaining $35,000 for. And if I don't have a good answer for that, that could negatively impact my application process as well. So you want to be very clear on what your use of funds is for, as well as how much you need. So let me know in the comment section below, are you planning to apply for a personal loan anytime soon? And if so, what is your use of fund? And if you feel like you've benefited from this video in any way, please don't forget to subscribe to this channel, hit that thumbs up button, as well as ring that bell icon so that you get notified when I upload new weekly content. Until next time, guys, thanks for watching. My name is Dexter, and have a wonderful day.